Hello friends, welcome back to the channel. Today in this video, I will show you a situation and you will have to tell me whether you have faced a similar kind of situation in your stock investing journey or not. So what you see on your screen is a typical stock behavior where you can see a stock has been climbing steadily for some time, and beyond a point which I have marked as a crisis point, the stock price begins to fall and it falls continuously for some time, and then there is an inflection point, and beyond that point the stock behavior begins to change. You must have experienced that there are some stocks which will recover rather fast, and there will be some stocks which will recover but their recovery will be rather slow, and some stocks will continue to perish even after the inflection point. So we as investor, we must have always wondered why this thing happens. Why after an inflection point there are some stocks which recover very well and many stocks are there which either recover too slowly or their recovery is nothing, they continue to perish. Why this happens? This is what we are going to discuss in this video, and I want to highlight this crisis situation a bit because in our investing career this is the point that will happen repeatedly. It is not that this crisis situation will occur once in a lifetime. It will happen time and again. For example, you can see in the last 25 years of our history, we have seen in 2001 we have seen a dot-com crash. In 2008 there has been the debt crisis in the US, and because of which the stock markets all over the world has fallen. In 2016 we saw a brief crash in the stock market due to the Brexit. Then in 2020, we all know there has been a COVID crash, and 2022, Russia-Ukraine war started, and in 2026, we all are witnessing now the after effects of the US-Iran war. So this crisis point will always come. We cannot avoid this, and we have to learn to deal with these crisis situations. In stock market, this crisis will always happen. You can see in the last 25 years, there has been multiple instances of this crisis situation. So it will happen, the stocks will crash, and there will be some stocks which will never recover, and some stocks will show a very fantastic recovery. So our question is, what are the difference between these three stocks, and we as retail investors, how we can differentiate between these three stocks? Is there a way that we can identify stock number one? We know that even these type of stocks will crash after the crisis situation, but we also know that beyond a point, these stocks will recover and their recovery will be fantastic. So what is the way? What is that one trick that we can follow that can guide us towards a better compounding in times to come? So this is the topic of this video, and let's see how to approach this investing journey. Before we go into the details of how to identify such stocks, let me start with a simple example. What you see on your screen are two tea stalls. This is tea stall number 1 and this is tea stall number 2. Both the tea stalls, let's assume, are located more or less in the same locality, and both the tea stalls generate almost similar kind of annual revenue. Let's say first tea stall generates a profit of 15,000 rupees and the second tea stall is also generating a similar profit of 15,000 rupees. But the difference between these two are, what is the invested capital of these tea stalls? The first tea stall has been installed with an invested capital of just 50,000 rupees, and the second tea stall has been installed with invested capital of almost 4 times 2 lakh rupees. But because both the tea stalls are able to generate only similar kind of profits, what is the return on invested capital? We will come back to this point to understand more details about return on invested capital, but just for the moment, remember this term. Return on invested capital of tea stall number 1 can be calculated by dividing its profit by the invested capital. For tea stall number 1, the return on invested capital is 30%, and for tea stall number 2, profit is 15,000, its invested capital was 2 lakh rupees, and hence its return on invested capital is 7.5 rupees. So you can see the difference. Same kind of business located almost in a similar location, they are both generating same profits, but because the invested capital of one business was much lower than the other, the return on invested capital for one it's 30% and for other it's only 7.5%. So let's take a more real life example of how to understand this concept of return on invested capital. So first of all, all, we will understand what is invested capital. Suppose, let's assume there is a steel plant, and to build a steel plant, what kind of assets we require? We will require a land, we will require a building in which the whole steel plant will be enclosed, and inside a steel plant basically there are a lot of equipment, but I have just, for example, I have shown a blast furnace. This is the blast furnace, and then there will be a slab caster or a billet caster, whatever. There is a caster, and then there is a rolling mill inside a steel plant. So all these together, this land, building and all these equipments together makes the fixed asset of the steel plant. Then there are other kind of assets in the steel plant. There will be a raw material inventory. To process the steel, we need raw materials, we will need iron ore, we will need limestone and other type of materials. There will be two types of inventory. First will be the raw material inventory, and then there will be the finished good inventory. There will be inventory, right? And then we will have to also factor in what the finance department of this steel plant is doing. They are managing two type of things. First, the finance department will maintain some cash balance in their banks, and then they will also manage the account payables, the bills that they have to pay to their vendors. Considering all these points, the fixed assets, the inventory and the account payables and the cash, we can say that in terms of formula, invested capital of any company can be its fixed asset plus its inventory minus the account payables. So this is how we can calculate invested capital of any company. Another formula that we can use to calculate the invested capital can be the total assets minus cash minus the current liabilities of the company. In terms of formula, return on invested capital is NOPAT divided by the invested capital. So we have seen what is invested capital. The NOPAT is this. NOPAT is calculated by EBIT multiplied by 1 minus tax rate. So we will not go into the calculation this time. We are just trying to understand the concept of ROIC first. So let's assume for this steel plant, the steel plant that we have taken in this example, suppose this steel plant makes a NOPAT of 5,000 crores and its total invested capital is 35,000 crores. So for this steel plant, the ROIC will be 14%. We have understood how to calculate ROIC, but just by knowing the absolute value of the ROIC, it's not helpful. We have to compare this ROIC with another metric, and after that comparison, we will come to know whether this company is worth investing in or not. So what is that other metric? The other metric that we call is WACC, or weighted average cost of capital. So what is weighted average cost of capital? Suppose in the balance sheet, a company has 65% equity and the balance 35% is the debt. It has taken the loans. So these are the two source of funds of the company. And suppose the cost of equity of the company, let's say, is 12% and the cost of debt of the company is, say, 10%. So how to calculate the weighted average cost of capital, WACC? It will be 65% into 12. 65% is the equity, 12% is the cost of equity, plus 35% is the weight of debt. And what is the cost of debt? Cost of debt is 10%. So the weighted average cost of capital of this kind of capital is 7.85%. So this is the weighted average cost of capital. So what we have to do is we have to compare the calculated ROIC that we have calculated as 14% for the steel plant, and suppose for the same steel plant the weighted average cost of capital was 7.85%. So we have to compare its ROIC with WACC. As a rule of thumb, the ROIC must always be greater than WACC. If this situation is there where ROIC is greater than weighted average cost of capital, that company becomes a value creator. And if ROIC is less than WACC, it is a value destroyer. This is a very important point to understand. No matter if the company is generating positive net profits, but if its ROIC is less than its weighted average cost of capital, it is a value destroyer. So what we retail investors generally do, we look at the price trend, we look at EPS growth, we also may look at the price earning ratio, we look at these parameters and we think that not bad, this company is doing well. It is, first of all, it is generating some profits, it is also growing its EPS over the years, and we also try to follow the price trend, because when we see a steep price fall and we see that its PE is falling, we see all these as an indicator that we can buy a stock. But remember, no matter if these all signals are showing a positive sign, even then that company can be a value destroyer. Why? Because of its ROIC being less than weighted average cost of capital. So it is very important for us as retail investor to understand this nature of business, that whether the return that it is generating is greater than its cost of capital or not. And for that, we have to compare its ROIC with WACC. So our goal is to always invest in such stocks whose return on invested capital is greater than weighted average cost of capital. So this is our goal. And our second goal is we have to avoid investing in those companies which are value destroyers. But when you will actually go and start investing, you will face a very practical issue. Most of the stocks, let's say we have 5,000 stocks listed in our stock exchange. Most of the stocks that are listed, you will find that most of the stocks will show a return on invested capital in this range, whose weighted average cost of capital will be in this range. So they are very close. When we see this value ROIC greater than weighted average cost of capital, because you see here ROIC is 12% and weighted average cost of capital is 11%. Because ROIC is greater than weighted average cost of capital, it is a value creator. So maybe we can buy this stock. But the thing is, calculation of return on invested capital and calculation of weighted average cost of capital is not a very absolute kind of thing. We can make mistakes. For a company, if we think that we have calculated a return on invested capital, the actual return on invested capital of the company can vary. Suppose in this case, instead of 12%, the actual return on invested capital of that company is 11.5%. It is just a 0.5% difference. And similarly, the weighted average cost of capital calculated here was 11%, but actually it is 11.7%. So you can see, just due to this small difference in calculation, the same company which was looking like a value creator here has suddenly become a value destroyer. So this is the problem. 90% of the stocks that are listed in a stock exchange falls under this category. Most of them are like this. So what we retail investors should do, we should focus on investing only in very high ROIC stocks. Big investors, professional investors, like banks, like mutual funds, like financial institutions, like big hedge fund managers, they have lot of tool, they have lot of people, they have lot of data with them. They can do a very accurate measurement of these two values of ROIC and WACC. With their precise measurements, they can actually know if a company is a value creator or it is a value destroyer. But for us, there are limitations. We have limitations of time, we have limitations of data, we also have limitations on our know-how. So even though we know to calculate ROIC and WACC, we are never sure that whether our calculations are accurate or not. So what we can do? We can invest in those companies, let's say, whose ROIC comes out to be 30% and whose weighted average cost of capital, let's say, is 10%. So you can see the difference. Even if we have done a mistake in calculation of 30%, let's say even if it becomes 20%, still it will be much higher than WACC of 10%. Generally speaking, for Indian companies, the WACC always works in this range. It will be in between 10% to 14% range. Even if we do a mistake, we can make this assumption that the weighted average cost of capital will be in this range. So if we find a company whose ROIC is much higher than this number, we are in a safe zone. So till now we have discussed that why it is essential for us retail investors to focus on high return on invested capital companies. There are professional investors who can afford to invest in lower ROIC companies because the kind of resource that they have. But we retail investors, we do not have so much leverage. We have to play safe, and how we can play safe? By investing only in high ROIC companies. Now let's take some examples of those stocks which has consistently generated high ROIC compared to their weighted average cost of capital. And these companies have been able to generate very high ROIC because they have a very strong competitive advantage. It means that they have a superior brand name compared to the competitors. They have a reliable products. The customers like them. They have a very high quality products to offer. And second, they also have a pricing power. And when I say pricing power, it means that when other companies are pricing, let's say, their products at 100 rupees, these companies can even price their product at 125 and still survive. So this is called pricing power. So in India, the companies that have high ROIC generally are Nestle, Britannia, ITC, Asian Paints, our top IT stocks. These are just few examples. There are many other companies which report very high ROIC, but just for the sake of perspective, I'm mentioning only these companies. And which are those companies which have low ROIC? Generally, all capital intensive companies report very low ROIC numbers. They are all steel plants, cement plants, infrastructure projects, banks, NBFCs. They report very low ROIC. There is also one thing that we have to understand. All these high ROIC companies, you will note that they always trade at a very high PE multiple. So there is always this risk of investing in them because they always trade at overvalued price levels. And similarly, you can see this, though these are low ROIC companies, but they generally trade at a lower PE compared to these type of companies. Their growth is slow. The growth of these low ROIC companies are also slow. So you can see we as investors should understand that though we want to invest here, but we also have to balance the valuation part as well. High ROIC has inherent benefits, but they always trade at a very high PE ratio. Low ROIC companies, we know that we must try to avoid them because we don't know whether their ROIC is greater than their weighted average cost of capital or not. But the advantage with investing in low ROIC stocks is that they are available at a comparative better price to earning ratio. Though they grow slow, but at least we have that psychological advantage that we are not investing in an overvalued stock. But what I do, for me, the focus is always this. I wait. I'm never in a hurry to buy a high ROIC stock. What I do, I prepare a list of high ROIC stocks and I keep waiting for a price crash. Whenever a moment comes, it can be due to an external crisis or it can also be due to the internal problems of within the company. Whenever the price crashes, at that is the time when I go and start buying them. So I hope you have understood this concept and you have also got this answer that we have started with. What is the answer for this question that we have posed at the starting of the video? At the starting of the video, we talked about that in a crisis, all kind of stocks crash. But beyond a point, beyond this inflection point, only few stocks are there whose rebound is very fast. The other stocks either rebound slowly and there are some stocks which do not rebound, they continue to perish. But what is the reason why some stocks rebound very fast? These are those stocks whose ROIC is greater than their cost of capital. So our focus should be here, how to identify these stocks, prepare a watch list of those stocks, and whenever there is a situation in the market where the prices of these high ROIC stocks are crashing because of some reason, you can see there are multiple reasons that world will give us. During those times, our target is to buy those stocks during those times, because most of the time these high ROIC stocks trade at overvalued price levels. Thank you very much for watching.